Hello everyone, welcome to Rajeshwari's Commerce and Management Study Hub. I am Rajeshwari here. Let us discuss today preparation of financial statement. We are keeping a record of all the books of accounts. That is, we are maintaining books journal, then we are posting them into the ledger, we are preparing subsidiary books, or we are preparing cat book and other related books also. What is the major objective of this record keeping? The main objective of record keeping is for the preparation of financial statement and to know the financial position of the firm, that is operating result. Without knowing a result, how you will make further decisions, right? That is why you need to maintain all the books of accounts. With the help of books of accounts, you are preparing the financial statements. The financial statements will help you to understand the financial position, financial progress and financial performance of the firm, and that helps you for the better decision making, right? Under financial statements, we don't have a separate act for financial statement act, but under the companies act we have separate sections for the financial statement. Totally we have 5 sections for the financial statement under the companies act 2013. The first section is section 129. This talks about preparation and presentation of financial statements, including consolidated financial statement if applicable. Then section 133. Section 133, it is talks about mandate compliances with the Indian accounting standard, which are based on the IFRS, that is International Financial Reporting Standards. Then section 134 gives outline for the requirement of board reports to be attached financial statement, including explanation or comments of the auditor report. Then section 139, it is about the appointment of auditor and their responsibility in auditing the financial statement. Then section 138, this gives a specifies time limit for the filing the financial statement with the register of compliances. So what are the section? Section 129, this is about preparation and presentation and present. Then section 133, section 133, that is mandate compliances. Then section 134, outline for the reports. Section 137, for the appointment of auditor. For the auditing the financial statement. Then section 138, this specifies the time limit. So these are the sections which deals with the financial statement. Now, what are all the statements we are preparing under financial statement? The first statement which we are preparing under the financial statement is income statement. Income statement, it is also called as the profit and loss account. Profit and loss account. Before income statement or profit and loss account, first we will prepare trading account. Trading account, then balance sheet. Here, Trading account, it is related to the all the activities which are cost of goods sold, whatever they have spent, and revenue which they have earned, that is sales. It is a statement of trading, buying and selling, that statement. And here under trading account we are recording only the direct expenses which are directly attributable to the manufacturing concerned. That is why trading account is prepared, and here we are preparing to know the gross profit or gross loss of the firm, and then the gross profit or gross loss will be transferred to the profit and loss account. Profit and loss account. And trading account, income statement, it is a nominal account. Trading account is also a nominal account. That is why they both, we are preparing the income and expenses statements, right? Profit and loss account, we are preparing all the expenses which are indirectly attributable to the manufacturing concern. Okay, it is indirect expenses, indirect incomes will be shown under the profit and loss account. Direct expenses and direct incomes will be shown under the trading account. Then balance sheet, it is a statement of assets and liabilities. We are preparing to know the financial position of the concern. That is financial statement. These are the financial statement. Let us understand each account. What is the pro forma for preparing the trading account? Trading account. This is also like a ledger account only. It will be in the T form. We have two sides, debit side and credit side. Here we are debiting all the expenses, that is cost of goods sold, whatever we have spent to sell goods, right? That is for manufacturing. That is those we are recording, those expenses we are recording debit side, and incomes we are recording credit side. And opening balance comes under the debit side. To opening stock, because without stock you are not starting the, that is opening stock means the finished goods which is remaining lying in the storeroom. Opening stock you are recording. And purchases, any additional purchase of material if you have done, that will be recorded. And purchase return should be deducted from this in case of any returns is there because of defect or overstock, then the return should be deducted. Then wages, wages will be a direct, it is a direct expenses paid to the laborers who are involved in the manufacturing activity. Then to other direct expenses. While solving the problem, we will understand which are all other direct expenses are coming. Other direct expenses, all the direct expenses, only direct expenses we are recording under the trading account, right? Indirect expenses we are recording under the profit and loss account. Then sales, that is a revenue which is you have generated. Sales, in case of any sales return, that should be deducted. Sales returns. Then closing stock. Closing stock. Now, in case your credit exceeds the debit, then it is a gross profit. Gross profit. It should be transferred to profit and loss account. Profit and loss account. In case debit exceeds the credit, it will be a loss by gross loss. Both we are transferring to profit and loss account only. Transfer to profit and loss account. In case profit, we are transferring to credit side of the profit and loss account. In case of loss, we are transferring to debit side of the profit and loss account. This is about the trading account. The trading account, we are debiting all the expenses, that is direct expenses, and incomes we are crediting direct incomes, and sales whatever we have generated Closing stock should be credited. Opening stock we are debiting, and opening stock is nothing but the finished goods. In additional purchase if I have done, that should be recorded, and purchase return should be deducted from that. And total gross sale, from that we are deducting sales return, then we will get net sale. This is about the trading account. Let us understand the profit and loss account. Profit and loss account. Profit and loss also have two sides, debit side and credit side. Here we are recording all the indirect expenses. First we are transferring the gross profit or gross loss. In case of gross profit, by gross profit brought down. In case of loss, to gross loss brought down. This is the balance we are transferred from the trading account. Then we are recording all the indirect expenses under debit side, indirect incomes under credit side. So indirect expenses, all the expenses which are attributable, which are related to the manufacturing, whatever you have spent, which is comes after the manufacturing, in office, administration expenses, till the selling, whatever expenses comes, all those expenses we call it as the indirect expenses, and all the expenses we are showing under the debit side of the profit and loss account. To administrative expenses to office salary. If salary only is given, also we are recording under debit side only, and in the profit and loss account. Commission paid we are recording under debit side. In case any commission received, we are recording under credit side. Commission received. Then to travel and conveyance, to rent. This is office rent. Factory rent, in case given, that should be recorded under the trading account. Office rent we are recording under the profit and loss account. To advertising, to audit fee, to insurance, to repairs, to selling and distribution expenses, to bad debt, to sales commission, to interest on loan, to depreciation, to bank charges, to loss of sale of asset. In case profit on sale of asset should be recorded under the credit side. By interest received, by profit on sale of asset, any rent received. Now under profit and loss account, we are Balancing figure will be called as net profit or net loss. In case credit exceeds the debit, then it will be called as to net profit. This will be added to the capital under the balance sheet. With capital, we are adding this net profit. In case of net loss, if debit exceeds the credit, then it is by net loss. This should be deducted from the capital under the balance sheet liability side. Okay, this is about the profit and loss account. Here we are balancing the gross profit or gross loss from the trading account. Then we are debiting all the expenses, indirect expenses. Remember this. Trading account means direct expenses. Profit and loss account means indirect expenses. And indirect incomes we are recording, and balance will be called as net profit or net loss, and that will be transferred to the balance sheet. Under the liability side, capitals we are adding in case of net profit, we are subtracting in case of net loss from the capital. This is about the profit and loss account. Let us understand more with the questions. I am solving questions from the institute material. Illustration 1. Following are the ledger balances presented by Miss P. Sen as on 31st March 2022. Stock 1/4/2021, that is 1/4 means opening stock. This should be debited. Purchases, carriage inward, wages, freight, sales, returns inward, returns outward, royalty on production, gas and fuel. Here additional information is also given. Stock on 31st March 2022. 31st March means it is a closing stock. Sometimes date only will be given. You have to understand. So opening stock and closing stock. Market price is 24,000. Cost price is 20,000. When market price and cost price is given, you have to compare both. Whichever is lower will be considered. Then stock value 10,000 were destroyed by fire, and insurance company admitted the claim to the extent of rupees 6,000. Goods purchased for rupees 6,000 on 29th March 2022, but still lying in transit, not at all recorded in the books. Goods taken for the proprietors for his own use for rupees 3,000. When own use they are taken, it is called as drawings and it should be deducted. Let us solve this question. Here we have a pro forma for the preparation of trading account of Miss P. Sen for the year ended 31st March 2022. Debit side, credit side. First we have opening stock. First we need to record opening stock. To opening stock. Opening stock is 10,000 that we are recording. Then purchases. To purchases. For purchases we have adjustment. Purchase is 1,60,000. From this we have returns outward. Whatever we have purchased we have returned. That is purchase returns is also called as returns outward. Returns outward 10,000. One more adjustment we have for purchases. It is 1,50,000. Proprietor used 3,000 for own use. It is called as drawings. Less drawings 3,000. That should be deducted 3,000. One more adjustment we have for purchases. Goods in transit it is there. Still it has not shown in the books of accounts. So that should be added. Add goods in transit 6,000. 1,47,000 plus 6 is 1,53,000. 53,000. Right? 1,53,000 is the purchase that we have recorded. Then we have wages. To wages. Wages is a direct expense. For wages we have adjustment 30,000. Outstanding wages is there. Outstanding means not yet received. That should be added. Outstanding wages is 4,000. Total 34,000. Then we have carriage inward. Carriage carriage inward is 10,000. Then freight. Freight for freight we have adjustment 8,000 and prepaid should be deducted. Prepaid means already paid in advance. Prepaid minus 1,000, 7,000. To royalty for all the expenses first we are recording. Royalty on production 6,000. To gas and fuel 2,000. Now we'll record all credit items, that is credit side by sales. For sales also we have adjustments. Total sales is 3 lakh. From 3 lakh sales return, it is less returns inward. Inward. Returns inward is 16,000. 3 lakh minus 16 is 2,84,000. Then closing stock. Closing stock is 20,000. For this we have adjustment. The stock which is given in the adjustment destroyed by fire, they have agreed to pay rupees 10,000. So that should be added. Stock destroyed by fire 10,000. Total 30,000. And we have goods in transit still not yet received. That should be added in the closing stock also. Goods in transit total 36,000. Now 2,84,000 plus 36 is 84, 36, 3,20,000. 3,20,000. Here credit exceeds the debit, so it is a net profit 3,20,000. To it's a gross profit. It's not net profit because we are preparing the trading account, so it is a gross profit transferring to profit and loss account. Transfer to profit and loss account. Gross profit transfer to profit and loss account. Now 3,20,000 minus 10 plus 1,53,000 plus 34 plus 10,000 plus 7,000 plus 6,000 plus 2,000 minus 3,20,000 is 98,000 is the balancing figure. The gross profit which we are transferring to the profit and loss account. First we have recorded all debit side the expenses, cost of goods sold, and the expenses we have recorded. That cost of goods sold includes the direct expenses also. Here credit side we have recorded sales and the closing stock. This is about the trading account. Let us solve the next question. From the following particulars presented by Mr. Shankar for the year ended 31st March 2022, prepare a profit and loss account after taking into consideration the given details. So what are the given details? Gross profit is given. Gross profit is 1 lakh. Rent expense 22,000. Salary 10,000. Commission credit means it is a commission received. Credit given 12,000. Insurance 8,000. Interest credit. So interest received 6,000. Bad debt 2,000. Provision for bad debt 4,000. Sundry debtors 40,000. Discount received 2,000. Plant and machinery 80,000. Adjustments are there. Outstanding salary amounted to 4,000. Rent paid for rupees 11 months. Interest due but not received amounted to rupees 2,000. Prepaid insurance amounted to rupees 2,000. Depreciate plant and machinery by 10% per annum. Further bad debt amounted to rupees 2,000 and make a provision for bad debt at 5% on sundry debtors. Commission received in advance amounted to rupees 2,000. So here we have gross profit. So this gross profit we are transferring to credit side of the profit and loss account. Rent is a expense, so we are recording debit side. For rent we have a adjustment. What is that adjustment? Adjustment is only 11 months rent is paid. So 1 month is outstanding. What is the 1 month outstanding? 22,000 for 11 months divided by 11. So per month it is 2,000. 2,000 is pending. That 2,000 you need to add. So rent will be total 24,000. Salary 10,000. Outstanding salary is there, that should be added. Even salary is a expense, so we are recording under debit side. Commission is credit. Credit side we are recording. It is an income. Commission received 12,000. For commission received we have an adjustment. Commission received in advance to rupees 2,000 it is there. Whatever received in advance should be deducted. Then insurance 8,000 expense we are recording. For insurance, prepaid insurance we have, that prepaid insurance should be deducted. Then bad debt is there. Interest credit is there. Interest credit should be recorded on the credit side of the profit and loss account. For interest received we have an adjustment. Interest due but not yet received. It is called as an accrued interest. Accrued interest but not yet received. You know you are going to receive amount, already it is generated but not yet received. That should be added. Then bad debt. Bad debt is a expense that should be debited. And further bad debt is adjustment is given, that 5% you need to calculate on the further bad debt on the debtors. That is 2,000 further bad debt is given, that should be recorded, added to the bad debt. Provision for bad debt is a credit item that should be recorded credit side of the profit and loss account. Then sundry debtors is there for calculating the further bad debt. Type 5% is given no, for that calculation. Discount received is a credit side you are recording discount received. Then plant and machinery, to calculate the depreciation should be recorded under the debit side. It is a expense. Let us prepare the profit and loss account now. Mr. Shankar, profit and loss account for the year ended 31st March 2022. These details you have to write neatly. Then debit, credit. Let us record all the expenses first. We have Profit we have no. Let us transfer the profit by gross profit. You can write trading account also. Gross profit. Gross profit is 1 lakh. Then now expenses to rent. Rent 22,000. We have outstanding rent because this is only for 11 months. Outstanding rent is 2,000. 22 divided by 11 is 2,000. So per month it is 2,000. 1 month is pending 2,000. 22 plus 2, total 24,000 is the rent. Then salary. Salaries 10,000. For outstanding salary is there, add outstanding 4,000, 14,000. Insurance 8,000. Prepaid is there, that should be deducted. Prepaid 2,000. 6,000. Bad debt. Bad debt is 2,000. Further bad debt is given, that is further bad debt 2,000. Total bad debt is 4,000. Then depreciation is given. Depreciation on plant and machinery. It is at 10%. 10% into 80,000. 8,000 is the depreciation on plant and machinery. We have recorded all the expenses. Let us record all the incomes, credit side now. By commission 12,000 we have received in advance, so that should be deducted. Received in advance 2,000. 10,000. Interest 6,000. We have accrued interest. Interest 2,000. Then we have discount received. Received 2,000. Provision for bad debt. Bad debt 4,000. There is a new provision should be created. It is given. So that new provision should be deducted less new provision at 5% on 40,000. We have created further bad debt 2,000. So minus remaining balance is 38,000 on 38,000 5%. 38,000 into 5%, 1,900. 1,900. Total is minus 2,100. Now the total 1 lakh 20, 1 lakh 22, 100 is total. Now here credit exits the debit. The balancing figure is it's a profit to net profit. Net profit. Net profit is from 1 lakh 22,100 minus 24,000 minus 14,000 6,000, 4,000, 8,000. 66, 100 is the net profit. 1,20,000 to 100. So here profit and loss account. First we have transferred gross profit credit side. Then we have recorded all the expenses as per the adjustments given. Then we have credited all the incomes. Here credit is more than the debit, so that is why it is called as net profit. The balancing figure 66,100. This net profit we are transferring to balance sheet. This is about the Mr. Shankar's profit and loss account. Let us prepare next question. Next question is X, Y and Z are three partners sharing the profit and losses equally. Their capital as on 1st April 2021 were X 80,000, Y 60,000, Z 50,000. They mutually agreed to the following points. As per partnership deed, interest on capital to be allowed at 5% per annum. X to be received a salary at rupees 500 per month. Y to be received a commission at 4% on net profit after charging such commission. After charging all other items, 10% of the net profit to be transferred general reserve. Profit from profit and loss account amounted to 66,720. Prepare a profit and loss appropriation account for the year ended 31st March 2022. So here we are preparing the profit and loss appropriation account for the partners. Profit and loss appropriation account is an extension form of the profit and loss account. Once we find out the net profit, from that net profit we are making the adjustments. We are paying the expenses of the partners. That is called as profit and loss appropriation account. Let us prepare the profit and loss appropriation account. First we are transferring the profit, net profit of the partners from the profit and loss account by profit and loss account. Loss account. It is net profit transferred. 66,720. Now we are making all the adjustments. It is you are preparing in the company's point of view. For the company, for partner, whatever income, that will be an expense to the company, right? So here, interest on capital. For partner, it is an income, but for the firm, it is an expense. So we are debiting the interest on capital to interest on capital. Here we have three partners X, Y and Z. Interest on capital, it is allowed 5% on their capitals. What is the capital of X? 80,000 into 5%, 60,000 into 5%, 50,000 into 5%. 8 5s are 40, so it is 4,000. 6 5s are 30, 3,000. 5 5s are 25. 2,500, 2,500. Total 4 plus 3 7, 7 plus 2 9,500 is the total interest on capital. Now we have salary, two salaries. For X only we are paying 500 for 12 months. 500 into 12, 12 5 is 60, is 6,000, right? Then commission. To commission. Here only for why we are paying commission. Let us understand what is why commission will be paid after paying all the expenses. Our what is the commission is paid after the paying expenses. Profit available is 66,720. Out of this already we have paid 9,500 on interest on capital. 6,000 as a salary we have paid. So what is the available balance? 66,720 minus 9 minus 6,000. It is 51,220. And percentage of commission is 4%. After paying such commissions, total it is 104. Add the percentage, given percentage with the 100 into 4 divided by 104. So what is the commission? 1,970 is the commission. Commission 1,970. Then general reserve. To general reserve. General reserve we need to transfer to general reserve after charging all the items. That is 10%. All the items means already we know 51 to 20. Then 51 to 20 minus 51 to 20 minus 1970. Then available profit is for transfer to reserve 49,250. From this 10% we need to transfer. 49,250 into 10% is 4,925 is the reserve amount, because it is clearly said in the question after paying all the such items, then only we are transferring to general reserve. 4,925. In case it is not said also, we are doing the same thing from the profit. 4,925. Then any other adjustments? No other adjustments. Then we are transferring the profit and their profit to the partners capital account. Partners capital account. Balancing figure we are transferring to X, Y and Z in their profit sharing ratio. 66, 720, 66, 720. Balancing figure is from 66, 720 minus 6,770 minus 4,925. 44,325. Here 44,000 equally we are transferring, because profit sharing ratio is not given, so we are assuming they are equal partners, into 1 divided by 3. 14,775. 14,775. In the equal ratio we are distributing. This is about the profit and loss appropriation account. First we are transferring the net profit to the credit side of the profit and loss appropriation account. Then we are doing appropriations. This is all adjustments related to the partners. Yes, let us solve the next question. Illustration 4. From the following trial balance of Ms. GBJ and Sons, prepare the final accounts for the year ended on 31st March 2022 and also the balance sheet as on the date. Here we have trial balance. Trial balance is given. Balance of debit and credits. Stock on as on 1st April 2021, 2 lakh. Purchase and sales. Purchase will be recorded under debit side. Sales will be there under credit side. Bills receivable 50,000. Returns 1 lakh. Carriage inward 50,000. Debtors and creditors, carriage outward, discount. Debit side is paid or allowed. Credit side is discount received. Salary and wages 2,20,000. Insurance 60,000. Rent 60,000. Wages and salary. Bad debt, furniture, BJ's capital, BJ's drawings, loose tools, printing and stationery, advertising, cash in hand, cash at bank, petty cash, machinery, commission. Debit is commission paid, credit is commission received. Total. Adjustments. Finished goods stock on 31st March was valued cost price 4,20,000, market price 4 lakh. Depreciate furniture at 10% per annum and machinery at 20% per annum, and on reducing balance method, rent of rupees 5,000 was paid in advance. Salary and wages due but not paid rupees 30,000. Make a provision for doubtful debt at 5% on debtors. Commission receivable 5,000. Here we need to prepare trading account, profit and loss account, balance sheet. The complete final account we are preparing under this question. Let us prepare the trading account first. Trading account we are preparing for BJ's and Sons. First we are recording debit side, the opening stock. Opening stock 2 lakh. Purchases. For purchases we have adjustments 22 lakh. Purchase return should be deducted. Purchase returns 50,000. 21 lakh 50,000 to carriage inward 50,000. Wages and salary, that is wages, that is why we are recording salary and wages. We are recording in the profit and loss account 80,000. Now credit side, first we are recording sales 35 lakh. We have sales return, that should be deducted. Sales returns 1 lakh. 34 lakh. Then closing stock we have. Closing stock 4 lakh. Total is 38 lakh. 38 lakh. From 38 lakh minus 2 lakh, 21 lakh 50,000, 80,000 is a gross profit. Gross profit transferred to profit and loss account 13 lakh 20,000. Gross profit we are transferring. Now let us prepare the profit and loss account. Don't write P and L, write profit and loss account for the year ended 31st March 2022. First we are transferring the gross profit by gross profit 13,20,000. Now let us write all the expenses. To administration expenses, we don't have any administration expenses. To salary, adjustment is there for salary, 2,20,000. Add outstanding salary, 30,000. 2,50,000. Depreciation on furniture. Furniture, it is 4 lakh into 10%. 40,000. On machinery. Machinery value is 3 lakh. On 3 lakh, 20%, 60,000 is the depreciation. Insurance, 60,000. Rent, 60,000. We have rent paid in advance, that should be deducted. Paid in advance, 5,000. 55,000. Printing and stationery, 30,000. Advertisement, 50,000. Carriage outward, 40,000. Discount allowed, 5,000. Whatever debit side it is there, that we are recording debit side only. Bad debt, it is 10,000. Commission, 10,000. To provision for bad debt, bad debt, 10,000. Now we will record all credit items. We have recorded all the expenses under the debit side. Let us credit now. First we have discount received. Discount received. Discount received is, it is 5,000. Then we have commission received. Commission received, 30,000. From this you need to add receivables, 5,000. Total 35,000. We have recorded all the incomes also. Let us take the total now. The total of credit side is 13,20,000 plus discount received is 5,000. It is not 50, it is 5,000. 5,000, then 35,000. 35,000. 13,20,000 plus 40 is 13 lakh 60,000. 13 lakh 60,000. So profit is 2. Net profit from 13 lakh 60,000 minus 2 lakh 50, 40,000, 60,000, 60,000, 55,000, 30,000, 50,000, 40,000, 5,000, 10,000, 10,000, and 10,000 is we will get net profit 7 lakh 40,000. This profit should be transferred to the balance sheet. Let us prepare now the balance sheet of the firm. Balance sheet as on 31st March 2022. Liabilities amount, and we have asset amount. Let us write the capital. BJ's capital is 5 lakh. We have adjustments for this. Drawings is there. Drawing should be deducted from the capital. It is used for personal purpose. And net profit should be added. Net profit 7 lakh 40,000. 5 lakh minus 70,000 plus 7 lakh 40,000. It is 11 lakh 70,000. Then current liabilities. You have sundry creditors 4 lakh. Outstanding salary 30,000. We don't have any other liabilities under the head. Fixed asset. Fixed assets. We have furniture. Furniture is 4 lakh less depreciation 40,000. 3 lakh 60,000. Machinery 3 lakh. Depreciation 60,000. 3 lakh minus 60, 2 lakh 40,000. Loose tools 1 lakh. Then we have current assets. Stock, closing stock 4 lakh. Debtors. For debtors we have adjustment. Debtors is 2 lakh less provisions 10,000. 1 lakh 90,000. Bills receivable 50,000. Cash in hand 45,000. Cash at bank 2 lakh. Petty cash 5,000. Prepaid rent 5,000. Commission receivables 5,000. Let us total this. 11 lakh 70,000, 4 lakh plus 30, 16 lakh. Asset side 3 lakh 60,000, 2 lakh 40,000, 1 lakh, 4 lakh, 1 lakh 90,000, 50,000, 45,000, 2 lakh, 5 plus 5 plus 5, 15,000, 16 lakh. Our balance sheet is tallied liabilities and assets. So first we have prepared the trading account, then we have prepared profit and loss account, then we have prepared balance sheet. I hope you all understood. Thank you for watching. Have a great day.